Good day, this is Don Vic Philip. Welcome to my trading channel. I hope you enjoy watching the video and I hope it's educative. I hope it makes you become a successful trader. Please, if you love the video, you can as well subscribe to my channel to receive more updates on how to trade on the forex market, most especially crash and boom synthetic indices traders. Thank you. Today, we are going to focus on how to trade using Fibonacci retracement. The first question that comes to our mind is, what is the function of this Fibonacci retracement? One, it makes us to identify our support and resistance zone. It helps us when there is a what? To identify when there is a pullback. A pullback is a temporary change in price by your broker in order to frighten or threaten the stay of traders. Most traders in a pullback tend to close in loss, and this is the aim of your broker. Like, for example, as you see here, if you see 1000 as a case study, what you see over here from this very point to this very point, you will notice it is an uptrend. We're using H1 as case study. All these red candles you see here are called pullbacks. Someone that entered trade at this point and seeing this pullback here might end up closing trade in loss, and this is the aim or the best motive of your broker in order to benefit from you. So in order to avoid such scenarios, your Fibonacci retracement is a very good tool in identifying pullbacks. Your Fibonacci retracement also gives you an entry and exit point in the market. It tells you when to enter the market and tells you when to get out of the market. After keeping in mind the function of this Fibonacci retracement, we're going to learn how to use it in trading. Please ensure you practice this very well. Ensure you create out time to practice it and backtest it. This strategy I'm showing you is proven to be 85% accurate, most especially when you combine it with your strategy and other indicators. Now, how do we draw our Fibonacci retracement? You first of all click the button. When you click this button, you click on your object. This is the object here. Okay, so it's like I click M1. You click this object over here. You click your add sign, this sign over here, your add symbol. Then you see it here, Fibonacci retracement. You click it. Now, there is something we should have in mind when drawing your Fibonacci retracement. There are two criteria that must be met. You must have a swing low and you must have a swing high. You must be able to identify these 2 points before drawing your Fibonacci retracement. What is a swing high? A swing high is the highest peak, the highest point of a what? Of a trade. That is your peak point, which is over here. this is your peak point. This is your swing low, your swing high, and your swing low. It is the lowest point at that trade at that particular time. The same thing follows here. The swing high is the highest point. Now, how do we draw it? You first of all put it at the point at your swing low. Good. As you can see how we drew it from our swing low, we drew it over to our swing high. As you can see, from this very point to this very point. You can draw it in a straight pattern, or you can draw it horizontally. But the main aim is let these numbers be directly towards this particular spot for you to easily identify it. Now, there are key levels when trading Fibonacci retracement, which are your 38.2, 50.0, and 61.8. These three key levels. They are very important levels when trading Fibonacci retracement. You can see as well follow this 23.6, 0.0, 100, and vice versa. You can use all of them, but there are three key points, which are 38.2, 50.0, and 61.8, because it's at this point that most pullbacks occur. If we as well zoom out from the market, you can see we took our lowest point and we took our highest point. Let me show you how this looks in our M30. Remember, we're using C1000 as case study. See how it looks. You can see that the numbers are showing. Let's go to our M15. You will see the black lines showing. These black lines are what is going to make you understand when there is a resistance or when there is a pullback. Now, let us start with H1 as case study. As you can see, when I was drawing my Fibonacci retracement, if you observe, there's something that happened at this very last candle here. Before this, there was something that happened here. Now, like I said, your Fibonacci retracement acts as what? Resistance and support. It tells you when there's a reversal and when there is a pullback. Now, when you draw this particular line, this Fibonacci retracement, make sure you understand this price, this key place. This 23.6, 8.2, 50.0, and 61.8. Let's use, for example, at this very point here. Let me start from this very point here. At this very point here. If you notice, when the price hits this very 61.8 mark line, you can see it, the distance between here and here. It's when it hits this 1.8 mark line, the market reversed. The buyers took full control. The buyers tend to push price up. As you can see what happened here. Now, if eventually the buyers couldn't beat the 60.0 mark, let's say at the At the point of reaching this 50.0, there was a drawback. There was a sell at this point, this 50.0. If you notice, the green candle beats the 50.0 mark. If eventually this 50.0 acted as a resistance and was able to push price down, then we will be expecting series of what? Sell candle. We would have been expecting series of sell candle if these buyers could not close up at this very point. As you can see, this is a closed candle. This was a confirmation. Remember, your Fibonacci replacement gives you a confirmation before you take trade. Seeing that this candlestick, these buyers, the buyers couldn't, the 50.0 mark couldn't hold the buyers down, you can now decide to take trade for 1 hour at this very point, beginning from this very point. When it's reaching this 38.2 mark line, you need to stop. Always understand that your key levels gives you entry and exit points. When you are in a market and you have reached a key level, please try as much as possible to close trade and understand the next structure in the market. Try to close trade and understand what the market is going to talk about. A professional trader, when he started a trade from here, he took a buy trade from here, he would be able to stop at this point, seeing that it's already reaching this 38.2, because this 38.2 can act as a what? Either a reversal or a pullback. But as you can see, the buyers was able to beat out from this 38.2 mark. So on seeing it beating out, what happened? Someone can decide to take a trade from the particular spot at which it was beat out and stop at this very moment. As you can see what happened here. Let's take for instance the same thing that happened here at this point. The sellers were able to push price up. Same thing that happened at this point. Let's take it as like it happened at this particular spot. Someone that didn't close his trade at this very point would end up being in loss. So please understand something. When you see your key levels, you take trade and you're already meeting the next key level, try as much as possible to close your trade. For professional traders or new traders, let me tell you what happened here. The buyers were able to beat price. The buyers bought to this very end. At this very end, when it was reaching your level 23.6 mark, the sellers pushed price down. They pushed price down, indicating a reversal. That was exactly what happened here. They pushed price down, indicating a reversal, but they were not able to push it to beat out this 38.2. Seeing this, one will need to have patience to understand what is going to happen within this 23.6 and 38.2. This, according to candlestick formation or price action, is a reversal. We should be expecting a reversal trade, in the sense that the sellers will start taking advantage of the market. So within the 23.6 or 38.2, we are going to understand the next move of the market. So the main aim now is to wait until price has either beaten this 23.8 and keeps on buying, or beats this 38.2 and keeps on falling. And if you see, when there was a confirmation at this spot, if you notice, the sellers beat price. The 23.6 enabled this to be a reversal. This is the confirmation you need. Once this 23.6 is able to turn this to a reversal, then you can start taking trade from this very zone. Because from this 23.6 plus 8.2, in order for price to push up, it would be between this line, this margin. So seeing this is the first confirmation. After waiting and you see this has occurred, you can comfortably take trade and stop at this very spot. Then it's already reaching this at 8.2. This will actually help those who trade short-term trades, especially those who are what scalpers and those who trade using 1 hour. Once it's reaching this at 8.2 mark, you stop, because there can be a reversal or a pullback. It depends. As you can see, it beat out it at 8.2. When it beat out it at 8.2, it kept on selling until it reached 50.2. This 50.2 acted as a resistance that pushed price back up. The buyers were able to push the price back up, which caused this reversal. So as you can see, these your levels are playing vital role when it comes to catching up spikes and following trend. This was the confirmation needed. Once the buyers were able to push price to be this at 8.2 mark, you can take trade from here. Yes, in the first instance, you might end up being a loss because the sellers pushed price down. You might end up being a loss. But after seeing this confirmation, you can peacefully take trade. See, it came into profit. So you see end up being a huge profit like you see over here. When you are reaching this spot again, you close your trade. You close your trade. Why? Because you are reaching this 23.6 mark. See, it comes to a reversal. When it got reversed, you can still place trade from here. Immediately you see this confirmation, you can still place trade. The same thing that happened there happened at the same spot. You might end up being a loss in the first place, but yet the price still pushed down. When you're reaching this 8.2, you close your trade because you are not actually sure of what will happen in the market again. The next confirmation you need to wait for is this. When you close your trade there, you wait for this candlestick to either, if it beats out of this at 8.2, you can now take your trade. But as you can see here, the buyers pushed price back up. So according to price action, this is a reversal for a buy. That means buyers are meant to take over from the market. That's why you need to wait for the next confirmation. Seeing this confirmation, upon this confirmation, when you saw that it has beat it at 8.2 mark, you can now start taking trades from here, hoping and knowing that it must reach this 50.0 line mark. So from this very point to this very point, you should be in what? You should be in profit. As you can see, it beat this 50.0. So you should be expecting, currently you should be expecting a fall to reach this 61.8 mark. If eventually it beats this 61.8 mark, that means this market will really be a sell. You should be expecting series of sell trends if it beats this 61.8 mark. But if it beats this 61.8 mark, it will need to go down to reach this 100.0. But observing it, if it doesn't, like currently here, this lower Bollinger Band is acting as a resistance point, if you notice. So you can still stop taking trade and observe. If it beats this lower Bollinger Band and beats this 1.8, you can comfortably take a long sell trend. Now we have analyzed it using H1. Let's go to our M30. M30, as you can see, the same thing still occurred. Though this upper Bollinger Band was acting as a support for the sellers, which 53.6 mark played a vital role. As you can see, when it beat this 38.2, this lower Bollinger Band is meant to have acted as a resistance, but it couldn't act as a resistance. Why? Because it needed to complete it to reach this 50.0 mark. It needed to complete it. If you look at here also, you should be hoping that either it acts as a resistance at this spot. If it breaks this, you should be expecting a sell trend. So for now, what do? You wait for a confirmation. That is the main aim. Always wait for a confirmation before jumping into trade. This last trade will determine whether you can take trade or not. If within these 30 minutes the buyers are able to push price up, then you can comfortably take from that 30 minutes a buy trade that will reach this 50.0. Then you close your trade. The same thing applies to M15. As you can see over here, from here it pushed price. When it was able to beat this particular spot, what happened? That was what indicated this sell. That this place actually played a vital role. So your Fibonacci retracement, learn to draw it from the top. From your higher time frame, which is your H1. Then you can use it to analyze all time frames before taking trade. Please combine this whole strategy with all time frames. Combine this whole strategy with all time frame. You will see the black line well drawn. You will see the black line well drawn. So please try as much as possible to combine it. Remember, we are hoping for a confirmation. If this candlestick can end up being a sell candle, a sell can occur at this spot, which hopefully, due to our strategy, we are 80% sure that a sell will occur, but we are hoping for a confirmation before trade can be taken. As you can see, when it hits this point, it's 3.6 points, it hits down. It was able to beat down to this very point. So this is how to trade using Fibonacci retracement. You can see the long spike that occurred. This is exactly how to trade using Fibonacci retracement. Currently, we are waiting for a confirmation if it's gonna fall or not. If it's gonna fall, we take our sell trade. If it's not gonna fall, we're going to take a buy trade. So always wait for a confirmation. Like after this now, as you can see, we're waiting for a confirmation, which is this candlestick. The next candlestick is a confirmation of what will happen in the market. So please, you can as well like and subscribe to the video, or if you still want more tutoring, or you need someone to train you on how to trade accurately in the forex market, you can still do well to contact me. I will drop my personal WhatsApp details in the description below. You can still do well to talk to me, confide in me on your trading strategies and your profit margin. Like I said, I do train and I do give signals to my students. Hopefully, I'm proud of my students that 90% of them are professional and successful traders. So if you're still interested in furthering how to learn the forex market, you can contact me. Let me just make a little summary of all I have been saying. First of all, you draw your Fibonacci retracement. How do you draw it? Like I said, you identify 2 points, your swing high and your swing low. You draw it from your swing low up to your swing high. Please don't draw it from your swing high to your swing low. No, draw it from your swing low to your swing high to be able to have these points that you see over here. We use C1000 as a case study. For your BOM 1000, draw from your swing high to your swing low. Your swing high is the highest peak of the market, while your swing low is the lowest peak of the market. Then ensure you always have a confirmation when using your Fibonacci retracement. Please and please, just don't jump into trade. No, always try to have an understanding of the market first, and please try as much as possible to practice it. I've been using this strategy for long now, so please and please backtest it and success in all your trade. Please don't forget to like this video and share it to your friends, those who trade crash and boom most especially. It's also applied to all forms of forex, but most especially crash and boom. So please, you can send it to your friends. Thank you and have a blessed week. Thank you.